Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Hello and welcome again to Rogue Trader, and today I'm looking at British Petroleum. BP are one of the world's largest oil and gas companies, and just like the rest of them, they've been going through a bit of an identity crisis in the last few years, and in 2020 they released their new strategy document, transforming to integrated energy company by 2030 in reaction to the worldwide net zero crisis. So in this graphic I've taken from their latest annual report, you can see the main features of how they're converting their company to a renewable future, and you can see it involves increased renewables investments from 1 billion a year to 5 billion a year by 2030, by spending 2 billion a year capex into their retail sites, particularly involving EV chargers, so that whereas they're now making money from people from filling up their cars with petrol, in the future they'll be doing the same, filling their cars with electrons, and divesting 40 billion of their gas and oil assets. The main features of BP at the moment is that they seem to be like a cash machine, raining down cash on their shareholders. They've got a massive operating cash flow of over 6 billion a quarter, and this is only being aided by the record high oil and gas prices we've been seeing lately. They've also got a 6% dividend yield locked in as their number one priority, and they're diverting 60% of their rather large surplus cash flow into share buybacks. In terms of their current hydrocarbon reserves, they're about 41% gas, and that's good because gas is the best of the fossil fuels. It's the last that will remain as the world phases out of fossil fuels, if it does. And so I was glad to see that gas represents 40% of their reserves. An interesting thing about BP is that they actually own a 22% stake in the Russian oil company Rosneft. So when you buy one BP share, you're actually also buying 0.2 shares in Rosneft. The Rosneft hydrocarbon reserves represent roughly half of BP's overall reserves, according to my calculations. So I look at Rosneft as potentially the ace in the hole. The Russian oil industry hasn't suffered the same as the Western oil industry encumbrances that they've had to suffer recently, and so that could be increased value there that represents half of their actual oil reserves. Of course, with the Russian connection and then some of the potential dangers there, it could also be the joker in the pack. Looking at BP revenues, and 3/4 of those are customers and products, with oil production being 13% and gas and low energy carbon being 13%. Now, looking within the customers and products, and here it's actually profits, but we see that most of that is actually just the BP filling stations, where you've got the gas pumps where they actually sell the oil, and then in the future maybe the EV charging points. But you've also got the fact that they're running like little mini supermarkets, and in fact a lot of their customers here don't even go in to buy oil. They're just their local convenience store. And BP's ownership of the Castrol business, that represents 24% of their customers and products business segment. But then when you look at actual profits, we see that 39% of BP's profits are from oil production, 33% from gas and low carbon energy. This business segment refers to natural gas and then also renewables. But actually at the moment, the vast majority of that profit is coming from the natural gas. They've barely got off the ground with their renewables. And 12% of their profits currently are from their ownership of Rosneft shares, with 16% being from their customers and products. So it's kind of alarming that they're planning to reduce their oil production by 40% by 2030, because that's obviously going to have a large impact on their profits overall. So they're planning to overcome this by increasing their number of gas stations and working on their gas station model. where they can make more money from the mini mark aspect and from them acting as cafes and from the introduction of EVs. But also they're opening gas stations, what they call strategic locations, and I'll come into that a bit more later. Then also they're investing in hydrogen, and they want hydrogen to be 10% of their core markets. And they're investing heavily into renewables, with their renewable capacity set to grow from 2.5 gigawatts to 50 gigawatts by 2030. Now, the one thing is we've had a energy crisis lately. So if the energy prices, if the gas prices stay up here towards $6, and the oil prices continue rising above the $83 mark, then that will actually make up for their loss in hydrocarbon production anyway. However, if that doesn't happen, then we have to rely on all this new investment they're doing in the customers and products in the gas and low carbon energy sectors for them to retain the same profitability that the company has at the moment, given that they're reducing their production of oil by 40%. So looking at their share price history, and back in 2018, they bought an oil and gas portfolio from BHP and acquired Chargemaster. Now, Chargemaster was the leading network of EV chargers in the UK, and they've now rebranded this to BP Pulse. And what I've learned is it's actually the largest network of EV chargers in the UK, and they have the lion's share of the fast chargers too. So we can credit BP with being leading in the EV charger network in the UK. So they kind of mean what they say to some extent. Then in 2019 was when they really had their identity crisis, and they started to set about their net zero by 2050 strategy. And in order to enforce this, they changed their chairman. Their long-standing chairman stood down. We now have Helge Lund as chairman, and they replaced their CEO with this new CEO, Bernard Looney. We then had the Corona crash, and BP have never really recovered, whereas most other stocks you look at have rebounded right back up since then. That hasn't really happened with BP, so you're still getting a Corona crash price. 2020 they achieved 6.6 billion of divestments, but they announced some new oil production. So there's some projects in India, Oman, the UK and the US. So there is still investment in their oil production side, and they were able to announce some retail site growth. So they're working on their customers and product segment here. They then released their 2020 new strategy document, and to go through this initially, the main areas were low carbon energy, convenience mobility and focus hydrocarbons. So their plan is a tenfold investment in low carbon energy, an increase in their renewable capacity from 2.5 gigawatts to 50 gigawatts, and for them to capture 10% of the core markets in hydrogen. They're also focusing on bioenergy, and they're doubling their liquid natural gas portfolio from 214 terawatt hours to 500 terawatt hours. They've then got convenience and mobility, where they're expanding their BP garage network. They want to double the number of customer interactions to 20 million a day, and increase the number of EV charge points from 7,500 to 70,000. And then on the focused hydrocarbons, they're reducing production by 40% of oil and gas, with no exploration in new territories. But what they plan to do is focus and get the best out of the remaining 60% of their portfolio. In 2021, they met their 35 billion net debt target, and they just had their third quarter results, where there was very strong cash flow and 1.5 billion share buybacks announced for quarter four. They'd achieved 10 billion of their 25 billion divestments already. They're now paying around a 6% dividend. So their financial frame is an important part of their 2020 new strategy. And so here we see the resilient dividend as their first priority. and they are paying a nice 6% dividend yield. Then their second priority is the strong balance sheet, and they've achieved this goal already. I have to note though, they do have 60 billion of debt still. They're investing at scale in the energy transition as their third priority, but they've set a parameter that the investments in wind and solar must return more than 8% in order for them to go into it. And they're investing still as a fourth priority in resilient hydrocarbons. So they are still going to be investing in hydrocarbons. The new investments must have a payback within 10 years or 15 years for gas. And there's a share buyback commitment as their fifth priority. So 60% of their surplus cash is going to be returned to shareholders by share buybacks. And that's currently equating to around 6 billion a year. There is actually literally money being rained down on their shareholders at the moment. All of their assumptions that go into their central strategy are based on $3 gas and $60 oil, when the reality is in 2021 we've entered this new energy crisis. Now, I invite you to go and look at my Greta Gold video series. I go into detail a bit how all the governments are now forcing the world energy markets into green energy, into renewables. But actually, a unforeseen side effect of this is an energy crisis that we're going through at the moment. And I think there's a good case for these high natural gas prices and high oil prices to persist for many years, whilst the world governments struggle to adjust to a green energy future. And so, given that this strategy document in 2020 was based at $3 gas and $60 oil, at these higher prices, if there is going to be an energy crisis, this means an absolute gush of cash coming back at BP shareholders. There's just no doubt about it. One thing I'll quickly mention about their overall strategic focus is I like the hydrogen component. There's going to be huge amounts of wasted energy. So that's wind energy that's produced when the energy isn't needed, and solar panel produced when it's not needed. And also lots of energy being produced, for example, in the deserts where it's not needed, or off the coast of Scotland when the energy is actually needed down in London. There's going to be huge scope for converting that and storing that energy as hydrogen and then shipping it to be used elsewhere. So it's kind of good that they're going into the hydrogen, because that's a means of storing that energy and transporting it to where it's going to be needed. And then it's great that they're investing in the liquid natural gas portfolio, because that plays into this hydrogen, because that liquid natural gas portfolio will be easily repurposed into hydrogen. They'll be able to use the same resources, the same assets for the shipping of hydrogen everywhere in the world when that happens. So I do kind of I think they're being quite clever there in their focusing still on liquid nitrogen gas, where they ease away on the oil and traditional gas, and they're using hydrogen to bridge that gap. So going into more detail here, in terms of low carbon energy, it's only actually a minor percentage of their overall revenues now. So I'm not going to go into all of these different projects that they're doing. You can always look into them yourselves. But as a general point, they seem to be quite heavy in solar. When I did my Greta Gold series, I identified wind as being better than solar, but maybe I was a bit UK focused there. To be fair to BP, their solar products are at least in hot places like Spain and the US. And their bioenergy is, that portfolio is, they've basically bought a company in Brazil, and that's mainly the production of ethanol from sugarcane. And they're currently producing 1.8 billion litres of ethanol a year, and they're supplying 1.2 gigawatt hours to the grid. So I think that is actually quite a sensible focus there. So I think it's good that they're investing there. If you think about E10 energy in the UK, where now you've got your petrol at your petrol pumps 10% ethanol, this is a nice logical link up, particularly for BP. Incidentally, in Brazil, they've been using ethanol to fuel their cars since the 70s to avoid being victims of the petrodollar thing. And so that's nice, albeit at a fairly low scale still. In terms of liquid natural gas, there's not much detail on that. Here you can see their goals of seriously increasing their portfolio. And I do think that of all fossil fuels, liquid natural gas is the golden child from my research I've been doing. So that for me is a great bonus. An example of their hydrogen is they've got their East Coast cluster thing going on in Teesside. You can see they're using wind energy. Some of that will be converted into green hydrogen. And they're also investing a gigawatt processing plant in blue hydrogen, where they convert their methane into blue hydrogen. So maybe the day will come where the carbon taxes and stuff on methane gas will be so high, it becomes more feasible just to convert your methane resources into blue hydrogen. Investing in green hydrogen and blue hydrogen at a scale, but really the amounts are still quite small over as a, you know, in the big picture of things. And I have noticed as well, particularly when I did my Greta Gold study, what I noticed was, although everyone's been talking about hydrogen as being the big solution, there's not really been significant at scale practical implementations of hydrogen. I see lots of startup companies and lots of things being done with on the back of government subsidies, but there's no massive scale adoption I can see of hydrogen. So it remains to see if it's hot air in the end, and hydrogen never really happens in a meaningful way. But still, at least BP have got the hydrogen base covered, particularly in how it could form a bridge between their wind turbines and their liquid natural gas network. So the convenience and mobility is interesting. As I said, lots of that is their BP garage network. They're increasing their retail sites from about 3,000 now to 8,000 by 2030. Each BP garage is essentially a mini supermarket. And actually, apparently, a lot of the customers that go in there don't even go in there to buy oil. They're just people who live locally, going in to stock up on bread and tea. So, you know, that is a positive use of these assets. And they plan, obviously, to, in the future, if we do go green, they can make money from people charging up their electric vehicles. They also, and tying in with the use of EVs, they've got their wild bean cafes at their BP petrol stations. So they want to make more money from them operating as a cafe as well as being a mini mart. And then what they've done that's quite clever is they've got their strategic retail sites, and India's a good example of this. Whereas apparently in India, passenger cars are growing sixfold in the next 20 years. And actually, a lot of that, I think, will be petrol still. So whilst in the UK, the governments are forcing everyone onto EV cars so that only rich people will be able to afford to drive, in India, their priority is lifting people out of poverty. And so as you get a massive middle class build in India, there's going to be a massive growth in the number of people driving petrol cars. So it's like, although they'll lose out in selling oil to customers in the UK and America, they can mitigate that to some extent by selling more oil in petrol stations in India. So this is actually a very clever move, I think, by BP. And then in terms of the EV charge point sales, well, in the West, where we're effectively going to be banning oil cars, they've got a leadership at the moment. The BP Pulse network at the BP garages is the largest UK public charging network. They also have the faster chargers and a good kind of app connection to that as well. They are showing leadership when it comes to the EV charge points in the UK. And also they're growing a presence in China, which is important because China do have an interest in EV vehicles, because in China they hate having to import so much oil. So again, it's changes that's been forced upon them in most strands of their strategy here for convenience mobility. It does all make really good sense, and so it's a strategy that I can kind of believe in. And then looking at focused hydrocarbons, there's no need for me to go into detail on all of these, but I've summarized here their current projects going on, and there is still quite a bit of exploration and production activities going on. If you look at the BP website, you can read into the detail on your own of the projects, the oil projects that are ongoing at the moment. But what I can say is what they mean by focused hydrocarbons is they're not expanding into any new areas or developing any new areas. What they're doing is, where they've got existing resources, they're then just adding a number of wells to then maximize profits from where they've already got all the oil assets in place in the area. They should get more bang from their buck with their remaining oil assets, even if they are off shedding 40% of their oil and gas assets by 2030. A couple of examples of that are they sold 21% interest in their Oman Block 61, which apparently are some of the best gas assets there are. So I don't like seeing that. And they sold their petrochemical business to INEOS. But where I think we are at the moment is it's mostly been getting rid of the fat in terms of their divestment activities. But the thing is, in the coming years, it might be that they start really digging into the flesh a bit. So to summarize their strategy, their financial frame is looking like it's going to bring in loads of money for shareholders, particularly at these elevated oil and gas prices, where they're moving into the renewables and they're focusing more on their convenience mobility. Every strand of their strategy I've looked at really does make sense, and it really does fit together. So on reviewing what they're doing, I am actually fairly impressed. And I think it's fair to say that if we have elevated oil and gas prices over the next decade because of the transition to renewables and the energy crisis that's forming, then actually those increased prices are going to make up for the loss in oil revenue anyway. But then, almost like as a second stage defense, if energy prices do drop back down because we enter into a renewables utopia, that's then where we rely this particular strategy to work in the renewables areas. But what they've presented, it's certainly a damn good go, particularly when you list their doubling of their liquid natural gas portfolio, their integration of hydrogen, and the fact that they are leaders in the UK in the EV charge space. So looking at the profit and loss, and we can see that their sales were quite high up to 2019. And then, of course, they dropped down sharply in 2020 because of the COVID impact and the lower oil price. Now, then in Q3, we've only got numbers up to Q3 2021. But here they announced quite a massive drop in sales, which is quite alarming because you'd expect them to have jumped back up to the 2019 levels. Now, when I looked into this, This was explained by a change in their accounting policy. Now, I'm no expert, and this is just my brief summary, so forgive me if I'm wrong and take that into account. But it's all down to the derivative contracts they use when they sell oil. So they agree to sell people oil, and between the time that they make that agreement and actually deliver their oil, they use the derivative contracts. And previously, their revenues were based on those contracts that had actually been executed after selling the oil on a gross basis. And what they've done is they've changed their accounting. So now, rather than doing that, they announce what the worth is of their oil sales in real time at any given point in time when they could do their quarterly reports. So you're getting a snapshot of the worth of all of these physically settled derivative contracts at that particular time. And they provided a breakdown where they restated their numbers from 2020, where that then actually was a 57 billion difference, which is about 40% of their revenues. So from this explanation, we can see by applying that 40%, we can see that if we'd been doing the calculations the old way, the revenues would be back up towards what they were traditionally. So I definitely don't understand that. It's a little discomforting, but I've found a reason for it. Now, that accounting treatment also affects the purchases as well on the expenditure side. Now, looking at operating profit in quarter three, already we're up at 13 billion, right back up where we were pre-COVID, with net income up at 6 billion. So this is really good news. This is a real good indicator of the health of this company in reality. The fact that in quarter three we're way up where we were in the whole year pre-COVID looks very promising. Now, unfortunately, in Q3 this year, I have to mention that they reported a quarterly loss of 2.5 billion. And so now I'm going to have to go and explain that. So that was because of adverse impact of adjusting items of over 6 billion to their detriment. Now, all of this was within their natural gas segment. And this was actually because of a change in oil and gas price within the third quarter. So in the third quarter, the price of gas effectively doubled. For the shipments they have going on in that quarter, those are all hedged. So the doubling of gas prices obviously then led to an absolutely massive negative impact of about 6 billion. Now, they kind of talk this away in their report, and then they point to their underlying profit loss, to how great they're doing. But the fact is, as far as I'm concerned, that was actually quite a nasty sting in the third quarter. But bear in mind that despite that really nasty sting, look at how well they're doing by quarter three compared with whole year 2019, despite that negative impact from that hedging. And also these hedging effects on their current gas contract, derivative contracts, although yes, that was really nasty for quarter three, you've got to realise that if the gas prices stay high, so they get a nasty 6 billion sting in quarter three, but then in longer term moving forward, if gas stays up at these levels because of the energy crisis, that's like a doubling of the value of all their gas assets. So it's like a 6 billion sting in the short term, but with a really nice outcome in the long term. So I'm kind of looking at this as a very small cloud with an absolutely immense silver lining. And don't let that detract from the fact that even including that little 6 billion sting, we're doing better now than we were in the whole of 2019 in terms of operating profit and net income. Moving on to the assets and debt. And most of their assets are dominated by their property, plant and equipment basket. with really their debt dominated by their long-term debt. And it'd be great to see them pay down this debt in the coming years. So here I've broken down their assets, and you can see, as you'd expect, a very large proportion of them are their oil and gas assets and then the infrastructure supporting them. When you look at their overall assets, their market cap is essentially all the net assets that they have once you take away their liabilities. So looking at my equity and valuation graphic, this is actually, at first glance, it looks like a good profile. Their market cap is below their net assets. That's by my analysis. I have a price to book ratio of 0.8, although it has to be said Reuters have one of 1.3. But nevertheless, their market cap's around their net assets, which makes them look very good value, particularly in these times. Of course, their revenue's dropping like this. We know that that's because of the new accounting methods they use. So overall, it's a bit of a hit and miss picture. Looking at the cash flow, and they have 17.5 billion of operating activities. They brought in 4.9 billion from their disposal program and 7.3 billion in new debt. On the cost side, they shelled out 9.2 billion in capex and 1.4 billion in share buybacks, as well as 1.6 billion in leasing and 14.2 billion paying off debt, plus 3.5 billion in dividends. In terms of its cash flow statement, BP is looking really healthy. This is one of the most healthiest cash flow statements I've seen as to date. When I take away the things that they don't have to do, we see they've got 18 billion of cash coming in and only 16 billion of cash coming out, including the 1.4 billion of share buybacks and 3.5 billion of dividends. So this company really does have a lot of positive cash flow. This explains all this money that they're returning to shareholders via dividends and stock buybacks. The cash flow, it really is a plus for this company. So I looked at into their shareholdings using this breakdown that you always get for each company, where they show the number and percentage of shareholders with particular ranges of shareholdings. And from that, given that only institutional investors are going to have more than $100,000 worth of shares, it's quite easy to work out, according to my calculations, that 97% of their shareholders are institutional asset managers. And this is really quite a frightening thing, and it's certainly been a main learning point of me this year in doing these videos, is that the retail investors really have no say in what direction the share price is going to go. The vast majority of shareholders are the big institutionals. Now, the majority of the shareholders, we don't know what they are, because I've had to indirectly know that they're institutionals from this method, but they're not actually named in the annual reports. Only shareholders of a particular size are actually named. But we know that JP Morgan own a quarter of the shares, and that although they'd started selling off this year, they haven't been doing any sell-offs. BlackRock have a sizable chunk, and they've not been doing any sell-offs. Vanguard Group have been selling off in 2020, but not in 2021. And we got this new player, Norges Bank in Norway. They've come in now with a sizable chunk only this year. So actually, overall, we don't see in 2021 that many of the real big lads selling off. But we do know that with the BP share price, there has been in the last few years a large downward pressure. I mean, generally, the BP share price has been generally flat this year, but that's only because a lot of downward pressure from these unknown institutionals in 2021 has been balanced by the share buybacks. So there's still a lot of downward selling pressure from these unknown institutionals. That downward pressure will end because they'll run out of shares to sell, and there'll only be institutionals who want to hold BP remaining. And then that could then lead to the share price bumping up as that negative share pressure is disappeared, and then we only have the positive pressure of the share buybacks. So to summarize, the financial framework that BP are operating in at the moment is going to be bringing back loads and loads of cash to shareholders in the near term, particularly at the elevated oil and gas prices. From what I've looked at their focus areas, I think that their renewable strategy, it does make sense and it all does seem to fit together. I think given the problem of having to offload 40% of your oil and gas revenues in the next 10 years, given that problem, the way they've approached the renewables and focusing on liquid natural gas, hydrogen, and on their convenience mobility sectors, they're doing the best they can. It looks like they're doing a really good job of trying to fix that problem. Now, I actually already bought BP back in June. And since that, we had the energy crisis really take into full force with large increases in oil and gas prices. But then more recently, in reaction to this, a lot of countries have started dumping their strategic reserves on the market to then artificially reduce the oil price. In the longer run, though, I don't think they can keep on doing that for too much longer. So the question is, would I invest into BP now? Well, I definitely think that I would, mainly because I think they're an excellent play on the energy crisis which is engulfing the world. Given their financial frame and what's happening with oil and gas prices, I really do think BP is going to be a cash machine for its shareholders as long as these high oil and gas prices remain. We're looking at 6% dividends and 4 billion a year share buybacks at the moment. In the longer term, the share price depends on either an entrenched elevated oil price or the success of their green strategy in replacing their 40% cut in oil production with new investments into renewables and their gas station and EV charge strategy. So they're definitely a buy for me at the moment. And if you hadn't already bought them, you could actually wait for the effect of this strategic reserve dumping to play out before buying them at a lower price. But once they are in your possession, the biggest warning light would be oil and gas price. So if for whatever reason, global recession or energy crisis goes away, if you see oil and gas prices dropping back down below $70 or $4 for gas, then it might be that this whole thesis is wrong and it's time to sell. Then in the longer term, it will be important to look at their annual reports and look at their revenues and income to see if their strategy is being successful in replacing the 40% drop in their oil portfolio with investments in their renewables and EV charging. Also, if you own any oil stock, there's always the risk of a Deepwater Horizon style disaster happening. So you've got to bear that in mind. That's a risk if you own an oil stock. And something else is, I noticed that part of their carbon neutrality thing is they're trapping a lot of CO2 in the North Sea, which they're calling carbon capture. That to me is a potential risk. What if there was some kind of disaster there? But otherwise, as long as this energy crisis continues with high oil and gas prices, I think it is going to be great being a BP shareholder. Of course, I'm just saying that for entertainment value as I vlog my own investment journey. And whatever you do, play safe, have fun, and thanks for watching my video.